Hello and welcome to KYC. I'm Anushri Vakharia and the company on KYC's radar today is Marathon Nextgen Realty. Now what I essentially want to know about this company, it's an interesting business development plan that they have. So firstly, how does the development of real estate shape with now the new Navi Mumbai Airport coming in place? Along with that, what would be in the focus is the overall infrastructure development also. How that would boost the overall prices and the volumes that we'll see for this particular counter with the new airport coming in place. What would also remain in focus is the growth plans going forward. Now we've already looked at the QIP. So with that, we have timelines of merger in place also. And with these unlisted entities merging into the listed company, what's the kind of valuation we'll realize is something that we should be watching out for. Apart from that, how will the merger improves company's overall land bank potential? Now the size is around 59,000 crore of GDP potential that we are looking at. So it's a considerable big chunk of land bank coming the picture in the next 12 to 18 months as per company's projection. So how will earnings improve going forward with this land bank coming in picture is something that we should be watching out for. But let's first understand what the company essentially does. Now, just about the company, it is a real estate based company which was established in 1978. So, long-standing presence is already that we are looking at. It operates across MMR regions, and if you just look at the main key land parcels, it has divided its segments in luxury residential with about 21% of mix over here, mid-size residential about 23%, and affordable also contributes higher to about 30% plus mix that we are looking at. They also have some bit of commercial portion is what we are seeing about 25% or also, divided in mid-size and large size is what we are looking at. Now coming to the projects in focus, luxury if you see, they mainly operated through their Monte South based brands. If you are looking at affordable housing is under Neo Homes is what we are seeing. Apart from that, what we are also looking at is commercial spaces with the branding of Future X is what we are looking at. Now, if you are just looking at overall large-scale townships, also next zone is in focus, but they mainly operate in Bhandu, Panvel, Lower Parel, Baikala and Mulund regions is what we are seeing. And with the ongoing merger in place, these three particular land parcels will have more of these 400 acres or of so land coming in picture. So that's particularly interesting as well. In fact, if you just look at the proposed merger of these key promoter-led entities, they will we'll be looking at unifying about 418 acres of land, which roughly translates to about 4.2 crore of square feet of land area. And this is across Panvel, Bhandup and Dombivali that we are mainly seeing, unlocking an overall potential of around 59,000 crore. So it's a big overall potential that we are seeing. But with that, let's understand how the company's metrics shape up. So we'll be talking about the key metrics that we usually do with real estate. So if you're seeing that in picture, we have your income statement in mind. There's key operational metrics as well. But I'll start off with income statement first. Now with income statement, what we are looking at is a 25% of a growth. This is in the 3-year picture scenario that we are seeing. What would be interesting is the growth outlook forward. In fact, the projection is about a 20% plus growth going forward, and this is for the PAT number that we've seen. So just on basis on that, we've given it a neutral rating. Because if we just see FY25, we did see some bit of that decline in revenue as well. So how does that shape up going forward is something we'll be watching. Coming to the key operational metrics now for real estate companies, if you just look at the revenues, that is more on the lumpier side because of the recognition patterns. So in FY25, we saw about a dip of 26% as far as where the pre-sales number was concerned. While collections, if we see also, there was about a similar kind of a decline that we are looking at. However, net debt to equity on the other hand is on a positive trajectory. FY25, this has come down to about 0.46 times as compared to 1 time, more than 1 times of ratio in FY23. In fact, if you just open the first quarter presentation with the QIP proceeds in picture, they are currently sitting at a net cash position. Just to summarize what has happened in Q1 also, booking value was up around 16%, collections was up around 29%, and they've achieved a net cash position. So given that FY25, we look at degrowth in terms of where these metrics are concerned. First quarter, they've made up for that, and we should be watching out for more quarters for the launch pipeline also that they have in picture. So that's on income statement and key operational metrics that we are looking at. Now coming to the balance sheet. If you just look at the overall book value, that has seen a significant uptick. Of course, this is with the fundraisers also being under the picture. We are looking at a 1,187 crore of a book value. This is in context with this. If we look at the borrowing, 560 crore, we're looking at a significant downtick from the previous levels. If you just compare that with FY21's book value to borrowing that we are looking at. With the QIP of 900 crore in place, they've also achieved a net cash position. So a thumbs up is what we give the balance sheet as of now. Now, important would be to track the cash flow performance of the business going forward. In FY25, they had a negative cash flow balance of from operating activities of 25 crore, while net cash flow stood at about 8 crore. Again, with the proceeds coming in picture, which they'll be utilizing towards these land development projects that they have in mind, how cash flows shape up is something that we should be watching out for. But for now, we've given this a neutral rating. Return ratios as well. We are looking at a 13% ROE number, ROC about 15%, while it is about the 15% range that we are seeing for ROC. We've seen a decline in terms of where the FY24 metrics are concerned, and this is also on the account of the profitability coming down in the previous fiscal as well. So important to keep a hold of how the metrics also go going forward, but for now we've given this a neutral rating. Shareholding is one interesting metric that we are looking at, and it's a thumbs up that we've seen. While if you look at the promoter stake, from 74% stake in March 23, it has come down to 56% stake. Of course, a lot of restructuring also going in the business. FII stake has increased significantly to 7% as compared to just 0.2%, while DI is also about 16% is the number that we are looking at. To just explain more about what's happened, I want to talk about the 900 crore of QIP that we've already been talking about on this show. So in June 26, the company issued about 1.6 crore of equity shares, and this happened at a QIP price of around 555 per share is what we are seeing. The fund usage would be investment in subsidiaries for about 160 crore. They repaid debt of around 360 crore. Along with that, they're also looking for acquisition of land worth about 300 crore or so. What was interesting with the key allotee names, we had Quant Small Cap and Large Cap Fund taking interest in this particular counter. Maybank Securities, Zeta Global Funds, and Sage One Flagship Growth were a couple of other counters that participated in this. Hence, we are looking at a spike in terms of where the FII and the DII metric is concerned. Coming to the seventh metric is the street cred. Now what we are seeing, the stock has not performed so well. If you just take the 1 year in conjecture, it's down about 8%, while 6 month also we are looking at a 13% of a return. So muted growth is what we are seeing for investor perspective. 3 years also about 163% is the kind of growth that we are looking at. So considering this, we've given this metric a thumbs down. But it's the outlook forward which is particularly interesting for the counter. Now they have about 300 crore of the QIP funds which will be utilized towards this land development and project acquisitions that we are seeing. But more than that, it's the listing, it's the overall merger of the unlisted companies and the listed company that we are seeing, which is going to unlock opportunities forward for the business. In fact, the projection is that in the next 2 to 3 quarters, they expect about 15 lakh square feet of launches, which roughly translates to a GDV value of around 4,500 crore. With this merger in place, there's also net value of incoming assets, which will roughly translate to about 3,100 crore. With this post-merger, the shareholding ratio will also go up to 74%. So you also have like favorable valuation in terms of a large bank coming back into picture. Along with that, even the shareholding for the promoters will increase back to 74% is what we are looking at. But this is the overall picture that we have. So if we just stack up all the ratings, we have overall given it a 5 on 8, considering that income statement operational metrics were neutral. Balance sheet, a strong growth picture going forward over here. While for return ratios, we've given it a neutral. Shareholding is particularly strong along with the outlook. While street cred is something that we should continue to watch out for it, since the stock has not done so well. If you take the 1 year in perspective, 5 on 8 is the overall rating that we have. But let's take this conversation forward with the management himself. We have Mayur Shah, the MD of Marathon Nextgen, joining us as well. Now, firstly, I want to start off this conversation by understanding this. You have a large transaction of land close to the airport. What happens to the overall real estate prices in the region? Do they rise, or does supply pick up because of these new projects in place?
See, Panvel, we are there, we're quite a long-term player for last almost 7, 8 years. We are doing Marathon Nextgen as a mini township, where we already developed 4,000 flats, out of which, almost 3,700 units are already sold. So there is a huge demand of an expansion of Navi Mumbai from, Kharghar to the Panvel area in any way, because the affordability in Panvel is still much better than the Vashi and Kharghar area. So there is a demand for the affordable housings of below between 60 lakhs to 1 crore is something which is the sweet spot of affordable housing what we have in Panvel. So and we are at Marathon. We are about to launch phase 3 of Marathon Next Zone, is close to 700 to 800 units. So there is a big demand, and with airport coming up, all these the employment generation which is going to happen because of the greenfield airport will be huge, in my opinion. And to that extent, the developments which are happening are not large scale. So definitely there will be a good demand, and there will be some slight appreciation in real estate prices going further in next couple of years.
Oh, Mr. Shah also wanted to understand now with the merger of these unlisted entities into listed company that we are looking at and the assets thereof, the expectation is that gross development value of the land will shoot up, and that makes the NPV of your projects also much better, and even the overall valuation becomes cheaper. So can you explain firstly when does the merger take place and what are the timelines thereof, and second, what are your development plans?
Yeah, so you're right. Like we have already filed the merger, and in the merger, the group entities where Bhandup we have almost 100 plus acres, Dombivali approximately 80 plus acres, and the Panvel region very close to the airport, another 190 acres or so. So altogether, 400 acres of the land of a group entity is coming into the listed entity, and we were actually waiting for all these infra projects to really come up, particularly in Panvel, the airport, the sea link, and now the suburban trains. So in next 2 to 3 years, we'll be really launching the township project in Panvel also. Another township level project. One is already going on, which is on a 26-acre land. The another land which we are going to start very soon. So definitely these infra projects, all our lands which are located in a very good connectivity area. Even Dombivali land is located very close to the new bullet train station which is coming up. So even Dombivali is also gearing up with all the affordable housing projects there. And Bhandup is also right in the midst of the LBS, very close walking distance from the metro rail which is on the LBS. So all these locations of our land are very, very good, and quite futuristic. And we see huge development potential coming in the listed entity post the merger is going to happen. The merger has really gone into step 2, like we'll be going into NCLT very soon in next 2 to 3 months, and we are hopeful that in 6 to 9 months the merger will be completed.
Okay, so when this merger does see the light of the day, what's the kind of earning growth potential that you see?
It's a very difficult to forecast those numbers, but in a percentage growth manner, we are quite our PAT as on last year was close to 190 crore, and we are looking at steady 25 to 30% growth in our PAT going further with all these development coming in, and the listed entity itself right now has a huge potential of Project Monte South, and there is a project of Bhandup and Mulund. So those projects are also contributing to the top line, and they are all with a good margin. Like our the margins are quite high in Mumbai, and that's the reason you are seeing our PAT is quite high on the on the top line. So going further, another thing is that we also looking at a very niche kind of a redevelopment, a cluster redevelopment projects in the South Mumbai. And couple of those projects are already tied up. At appropriate time, we will announce. So that also will boost the company's top line as well as a PAT. So, it's a very strong, long marathon run is coming up in next 3 to 5 years.
But just want to understand that are you being conservative with your projections considering you've already retired a large portion of debt in the QIP plus a 25% earning growth? With that seems conservative on basis of that. So just want to understand that.
Yeah, marathon is always whenever we have to focus something, we are very conservative, and we are always under commit and over deliver. Because what I'm trying to tell you is that see how these new regions demand will shape up will really come to know in 2 to 3 years, and that is how, because we have projects lined up. However, the demand should also pick up in a strong way as these infrastructures have come up. So if the demand really goes up in a big way, then definitely we will overachieve than whatever we are committing right now.
Okay, thank you so much, Mr. Shah, for joining and sharing that outlook on Marathon Nextgen going forward. It's interesting. We are looking at a 25% of a growth multiple from year onwards. 400 crores of acres coming into land with this merger taking in place in the next 12 to 18 months that we are seeing, which roughly translates to a GDP potential of around 59,000 crores. So that's Marathon Nextgen in focus for you. But that's all the time that we had on this edition of KYC. Do stay tuned. Markets at 12 coming up next.